A lot of changes in the mortgage industry since COVID-19. So here are two things I really want to make sure that you're aware of. First and foremost, the guidelines are changing and probably will continue to change as the weeks progress. But as of right now, we're starting to see some of the loan programs are really starting to tighten up. So we may have a slightly higher credit score requirements. We may have tighter restrictions on income, that sort of thing. So most importantly, what that means for you is just simply make sure that your buyers are fully qualified before you start looking at homes. Now, the second thing has to do with interest rates. And this is a little bit difficult to explain, but let me back up and talk through what happened about a month ago. So when COVID-19 hit China for the first time, it caused a massive sell-off on our stock market, which caused our mortgage rates to decline. So a month ago, buyers could have easily gotten a 3, maybe even a 3.5% interest rate, but definitely in the low 3s. Once COVID-19 hit the United States, our bond market took a big hit. That means that mortgage interest rates actually increased. So right now we have much higher interest rates than what we saw just a month ago. And here's what's happening. The investors are trying to protect themselves. Now, when I say investors, I don't mean people like Gershman Mortgage. I mean the really big investors that are actually setting the interest rates. They are actually stating interest rates are higher, and we know that buyers are going to grab that higher interest rate to purchase the home, and then maybe 3 months, 6 months, when the dust is kind of settled, they're going to go refinance in order to grab that lower interest rate. Makes perfect sense, right? Well, when a buyer refinances within a 12-month window after purchasing, it actually causes the investor to lose their shorts. So it really hurts the investor. So here's what the investor is doing. They're saying, okay, Mr. Buyer, I'll still give you the 3.5% interest rate, but now I'm going to charge you points. And the reason why we're charging points is because rates are actually higher, but I want to make sure that you stay in this loan for the next 2 or 3 years before refinancing. So here's what that means to you as the real estate agent. Be prepared. You're going to see a lot of qualification letters with an interest rate and points being quoted. It also means that we need to be very cautious with those first-time home buyers. If they're getting, say, an FHA loan and they barely have enough funds to come up with a 3.5% down, they may really struggle in order to purchase those points that are required in order to lock in that interest rate. I'm especially concerned about the USDA buyer who really doesn't have any money to come to the closing table and how we're going to justify those points. So you may see closing costs increase. If that first-time home buyer just has to have the seller pay their closing costs in order to purchase, you may in fact start seeing higher closing costs because we're rolling in points into those closing costs. Again, those are not closing costs or points that Gershman Mortgage is wanting to charge your buyer. It's just the hand that we're being dealt with at this point in time, and we have to charge the points right now. All right, guys, I hope that helps. Let me know if you have any questions. Stay safe out there, and we're always here to work together.